Hey guys, Rahul Shire, trying to make investing accessible and profitable for the average investor. One of Benjamin Graham's lesser known works is a fantastic speech he gave back in 1963, which is called as The Rediscovered Masterpiece by Benjamin Graham. You can search it on Google, I think you'll easily access it. It's chock-a-block with insights. In fact, even Warren Buffett calls it one of Benjamin Graham's best speeches ever. So do check it out, The Rediscovered Masterpiece by Benjamin Graham. Now, one of my favorite passages in that speech is where he gives this quote, where he says that in my 50 years, 50 years in the stock market, I have found that I know less and less about what the stock market is going to do and more about what an individual investor needs to do. And this is a very interesting take. He was, of course, towards the fag end of his career back in 1963. And with all the experience that he had before that of investing in stocks and predicting the stock market, he is finally forced to conclude that he doesn't know. He knows less and less about what the stock market is going to do and more about what an investor needs to do. Now, the reason, I think one of the big reasons he was forced to make this statement is because his previous predictions about the stock market had been way off the mark. Well, I won't call them exactly way off the mark, but he was wrong in a lot of his predictions about the broader stock market. In 1948, when the US stock market was trading at attractive valuations, he predicted that the stock market would do well, quite well over the next 5 years. And they of course did well. They went up 50% between 48 and 53. But 53, the next 5 year period, 53, he was cautiously optimistic about the stock market because they had run up 50% between 48 and 53, and therefore in 53 he felt that you should be cautiously optimistic even though the stock market is looking reasonably priced. But what happened between 53 and 58 was the stock market doubled, almost doubled. So they end up performing better than the period between 48 and 53. And 53 and 58, the stock market doubled. He gave another prediction. He made another 5 year prediction back in 58, and this time he felt that the stock markets were definitely expensive. They were trading at dangerous valuations, and one should stay away from them. What happened was he was once again proven wrong. The stock market going up another 50% or so. Of course, they were volatile, but they still ended the period 50% higher than 5 years back. So this time also he was proven wrong. Then came the next 5 year period, 63 to 68, 69, where he said that nothing doing, the stock market is very expensive. The last 15 year period that we have seen in the stock market is not going to be repeated in the next 5 years, and there's going to be a definite collapse in the stock market over the next 5 year period, and investors should be prepared for that. This time around, though, he was proven right, with the stock market collapsing over the next 5 year period, and for the first time in 20 years it ended at a level lower than the previous 5 year period. So in 1970 the stock market was slightly lower to what it was trading back in 1964. So 6 years of zero returns for the investor had he invested in the US stock market in 1964 and 70. So this 20-year period proved to be a very big lesson for Ben Graham. He was not able to recover from that. He made a lot of predictions, doing a lot of research, doing a lot of analysis, but despite that, his predictions on the stock market were proven wrong. They were way off the mark, and that's why he was, I think, forced to make that statement that in my 50 years of the stock market, what I have realized is that I know less and less about what the stock market is going to do, and more about what an investor needs to do, which is when he gave his famous formula of investing in the stock market, his famous idea, blueprint of investing in the stock market. And he gave a very simple suggestion. He said that if an investor has 100 rupees to be invested, he should split it 50-50 between stocks and bonds. And when the stock portion goes from 50 to 55, he should take money out of stocks, put that into bond, and bring back the ratio to 50-50 again. And when the stock portion, becomes 45 rupees, stock market falls, money should be taken out of bonds and should be put back into stocks, and the ratio be maintained at 50-50. This was his famous blueprint that is outlined in Intelligent Investor. Of course, you can be flexible with this approach, as Ben Graham says. Instead of 50-50, you can be 75% in stocks, 25% in bonds, if you are very confident about your stock picks and you are confident that the stock market is going to do well over the next 5 years. But he says that for a defensive investor, who cannot digest 40-50% losses in the stock market, 50-50 is a very good ratio, and you should keep using this mechanical formula over and over again. And if you do this, you're going to get decent returns from the stock market. And you should forget about predicting the market, because that's something which average investor or even the most sophisticated investor cannot do, because it's just a very complex beast to analyze that way. So, I see a lot of traders, a lot of smart investors trying to predict the next move of the market. They'll come up with all sorts of different analysis, price to earnings analysis. They'll, use CAPE method. They'll use market cap to GDP ratio. They'll use 200 DMA, charts and stuff. But I think the advice by Benjamin Graham makes a lot of sense to me, because market is a complex beast and it cannot be predicted. That's why that statement that he made back in 1963, that you should not predict the market, you should worry less and less about what the stock market is going to do and more about what an individual investor needs to do. That is the advice that needs to be heeded. And trust me, if you do that with the discipline and along with sensible stock picks, you will not get a bad result from your investments. So the question that I have asked in this video at the start of the video is, how long before the stock market crashes? Will there be a crash in the market? I think you got the answer to that question. Do not worry whether the market is going to crash or not. Stick to your plan. Worry less about the market. Worry more about what you're going to do. If you are planning to invest rupees 100 in the stock market, set 50 aside, put that into fixed deposits or bonds, invest only 50 rupees in the stock market. If the stock market goes up, if your stock becomes 55-60 rupees stock allocation, you can put the money into bonds. And if the stock market falls, you can take the money out of bonds and put them into stocks. So no need to do any sophisticated analysis. No need to lose your sleep over what the stock market is going to do tomorrow, 15 days from now, 6 months from now, a year from now. This is a very simple approach, and it also works quite effectively. So, try doing that, and I'm sure you'll not get a bad result. So that's all from me today. I'll see you again next time. Thank you so much.